Hi, I'm John Davis. I'm a CFF. I'm a financial planner. I focus on retirement and estate planning. Now, my clients are people who are nearing retirement and those who are already retired. Now, one thing I've learned over the years is that people need a unified, holistic retirement plan. What I mean by that is they have to coordinate all their assets. It's not just Social Security. They got to look at Social Security, they got to look at their IRAs or 401ks or pensions, and they got to look at how all of these things are working together. Well, let me ask you a question. Did you know that Social Security is $1 million asset? Well, what do I mean by that? It's $1 million asset because if you're a married couple, that's what you can expect to receive in benefits over your lifetime. And in fact, if you're a single individual, you're looking at about $500,000. So this is a really important asset, one that you don't want to get it wrong. Okay. Now, because Social Security is so important, if you contact me, I'll email you my 2022 Social Security Mythbusters fact sheet. You'll get that and you'll have all the facts that we're going to discuss here today right on one piece of paper. So let's look at the top 10 myths about Social Security. Myth number one, Social Security is going broke. It won't be there for me. Well, this comes to us from the coffee shop gurus. You know, they all say, get it while the getting's good because Social Security is going broke. Well, here's what you need to know. It's highly unlikely that Social Security will go broke. And in fact, in 2009, the government coined the term too big to fail. And Social Security, by its very definition, is too big to fail. I mean, think about what would happen if suddenly Social Security failed. We'd probably have a depression. Because if you think about what happens to Social Security money, you'll totally understand. I mean, when you receive your Social Security check, the first thing you do is you spend it, right? You go golfing, you go to restaurants, you spend it. And when you do that, you give employment to people. So the one thing that you need to understand is Social Security and most of the media tell you it's going broke. In fact, what they do is they tell you that in 2033, the program is scheduled to fund, and then after 2033, suddenly they're supposed to only be able to pay out 77 cents on every dollar in benefits that are due to recipients. Well, that would be a problem if Social Security was an entitlement program that had limited funding. But that's not how Social Security gets funded. It gets funded through taxes. In fact, 7.65% of every dollar that we earn in wages goes to Social Security and to Medicare. And it doesn't stop there because it's like a matching program. Your employer matches another 7.65%. Add that together, and 15.30% goes to Social Security and Medicare on every dollar that we earn. Now, Congress can solve the funding problem overnight. In fact, all they have to do is increase it from 7.65% up to 147,000 in wages that you earn in 2022. All they have to do is increase that to 10% and maybe cap it off at 200,000 in wages. So there you have it. Social Security won't go broke, but you can count on changes being made. They may change the claiming age. Right now, depending on what year you were born, you can claim Social Security at age 66 or 67. They may change that. Maybe they'll change it to 68 and 70. So again, this is why I say that you have to have a coordinated program, one that takes into account your Social Security and all your other assets, all as part of one plan. So I hope that clears up the issue. Let's take a look at the next myth. Myth number two is if I take a job that pays less, it will force my benefits to be less. Okay. Well, this is something that I hear from clients from time to time. I'll get a person that they had a job and the job had a secure wage, they received a salary, but they always had in the back of their mind that they wanted to get into sales, but they never wanted to get into sales because, well, the income could be sporadic. So what they're afraid of is they're afraid to take that sales job, maybe their dream job, but they're afraid to take it because they're afraid they'll earn less. And now all of a sudden their Social Security income will go down. Well, first of all, to address this myth, you have to know how you qualify for benefits. And then once you understand how you qualify for benefits, then you understand how they're computed. So first, without getting too boring here or too analytical, you got to qualify. To qualify for Social Security, you got to work for 10 years. And you earned 40 primary insurance amount credits. So basically, you earn, as you work, 4 credits per year, and you work for 10 years. Now, the great thing about Social Security is that those 10 years don't have to be consecutive. And that's really important to the moms out there, because if you took off time to raise a family, no sweat. It doesn't have to be consecutive. You could take off time to raise your family and then, go right back to work. It's not a problem. Now, to compute your Social Security benefit, the good news is that Social Security only looks at the top 35 years of your earnings. So if you take a job on that pays less, no worries, because they're only going to look at the top 35 years. So this way, you don't have to worry. Take on whatever job you want to take. And if it pays less, don't worry about it. Just do it. If you want to volunteer your time, that's great too. It's not going to hurt your earnings. So I hope that clears up that myth. Just do what you love doing. Okay, myth number 3. I can't stop my benefits after I start. In fact, that's a complete myth. You can stop. Not only can you stop, you can pause your benefits, and you can actually restart your benefits after you pause, or you can completely withdraw your benefits and start over. I guess the first thing we'd have to address is, why would somebody want to stop their benefits after they applied for them? So here's what would happen. Maybe they started their benefits, but like I discussed, they got a higher paying job, one that could actually increase their top 35 years of earnings. So maybe they want to stop. Maybe they received an inheritance, or maybe they won a lottery. I want to be part of that crowd, okay? Well, you can actually pause your benefits, not stop them, but actually pause them for a temporary period of time once you reach your full retirement age, which would be 66 or 67, depending on what year you were born. You can actually not only pause them, but you can actually completely stop them. You can actually do what's called a withdrawal of benefits. And in order to do that, what Social Security requires is that you file this Form 521. It's called the withdrawal of benefits form. Now, Social Security will allow you to do that one time. You have to do it within 1 year of when you filed for benefits. And the other requirement is that you have to pay back whatever you received in benefits. So you're actually able to do 2 things. You could either pause benefits, or you can completely stop them, but you got to remember that's Form 521. So I hope that addresses that question, that myth, and let's move on. Okay, the next myth is myth number 4. Social Security gets taxed the same as regular income. This is what a lot of people believe, and that's not true. Actually, Social Security is taxed on what they call a provisional income formula. And you don't have to be an accountant to figure this out. All you do is take your gross income plus any tax-free interest that you earn plus 50% of your Social Security check. So if your gross income from wages is, I don't know, $12,000 a year, and you get tax-free interest from maybe a municipal bond, you'd have to add that in and split half of your Social Security check, add that all together. And if you're single and you're filing as head of household, and that number comes up to be less than $25,000 a year, well, the good news is that your benefits are completely tax-free. If they're more than $34,000 a year, then up to 85% of your benefit, not the tax, 85% of your benefit gets taxed as part of your regular income. Now, if you're a married couple and your provisional income is $32,000, well, if it's $32,000 or below, then you have no Social Security taxes due. And if it's more than $44,000 a year, then up to 85% of your benefit is due. Again, This is why you want to have a program, you want to have a plan that incorporates all of your assets and coordinates all of your assets. You want a unified plan. This helps you plan your income and plan for taxes. All right, so I hope that clears up that myth. Let's look at myth number 5. Again, the coffee house gurus step in. Apply at 62. Apply as soon as you can. But here's the problem with that. That could have a huge impact on the amount of benefits that you actually get. You may or you may not want to do that. But before we get started, you have to write down on a piece of paper what your full retirement age is so that you know if you should do that or not, if you should apply or not, apply early or not. So your full retirement benefit age is age 66 if you were born between 1943 and 1954. Now, when I'm talking about your full retirement age benefit, what I'm talking about is that age at which you get 100% of the benefits that you're due. Okay, so if you were born between 1943 and 54, it would be 66. If you were born 1960 or later, your full retirement benefit age is age 67. So why is that important? Well, here's the thing about Social Security. You can apply as early as age 62 or as late as age 70. And if you're widowed, you can apply as early as age 60. Now, what we do is we recommend that you file at your full retirement age or later. Why? Well, the best thing is to give you an example. Let's say your full retirement age is 66 and you're going to get $1,000 a month. If you will apply at 62, anytime between 62 and age 66, you're going to get a lesser benefit. In fact, if you apply at age 62 instead of age 66, your full retirement age, you're going to get 25% less benefits. And that's a lifetime benefit. So that's really important. Okay. The other side is you can get credits. You can actually earn 8% per year for every year that you delay taking your benefits until age 70. So if you're age 66 and you wait till age 70, you can actually increase your benefits by 32%. Think about that for a moment. If you waited till age 70, you get $1,320 a month versus $750 a month if you applied at age 62. So that's hugely important. So running out and applying at age 62 is not necessarily a good idea. It's something that you want to give serious thought to before you go ahead and do that. Again, you want to coordinate your plan to take into account when you're going to need your income and what your future income will be. So I hope that clears up that myth. Let's move on to myth number 6. It doesn't pay to delay taking benefits because I won't live long enough to come out ahead. Well, this is another myth. This really is dependent on your health. But it's really a myth for most people. I mean, if you have ill health and you've had a history in your family, people dying young, well, then, you know, these numbers might not apply to you. You may want to take it early. But here's a fact. The average man's age nowadays is 86. Women are expected to live to age 89. So what we did is we looked at people taking their benefits at age 66, their full retirement age in many cases, versus age 62. And what we discovered is that if you live to age 76, you break even. Every dollar that you earn after age 76 would be a profit to you. You'd be ahead. If you applied at age 70 versus age 66, your break even would be age 81. So for every year that you lived after 81, you'd be coming out ahead. Apply at age 70 versus age 62, and the break even is age 79. Now you could tell that if the average man's life expectancy is 86 and woman's is 89, most people it's gonna pay off for them to delay. So I hope this clears up this myth. It's important to consider, though, all the facts, your health, and what illnesses you've had to deal with up until this point, and take it all into consideration. But know that delaying could be very profitable if you have a decent or an average life expectancy. So I hope that clears up that myth. Let's look at myth number 7. I can't collect Social Security and still work. And so a lot of people want to know, well, what happens if I'm still working and I want to take my benefits early? Well, this is something very important to consider. If you're too young and you claim it early, you may be subject to what's called the Social Security earnings test. So what I'm saying here is that if you're under your full retirement age 66 or 67, in 2022, you'll give up $1 in benefits for every $2 that's earned above $19,560 a year in W-2 earnings. And that's for 2022 again. So here's the thing about this though. If you're self-employed, you can actually manipulate this because you can control what you pay yourself in wages. But if you're not and you can't, well, then you know that you have an earnings limit of $19,560. Okay. Now, if it's the year of your full retirement age, so let's say that your full retirement age is 66 and you're going to be 66 this year, but it's not your birthday yet. It's just that you're going to be 66 this year. Okay. Well, in 2022, you give up $1 in benefits for every $3 that you earn above $51,960 in wages. Okay, so you have limits, and that's the earnings test. Now, here's the really great thing. If you're at your full retirement age, well, it's carte blanche. You can earn as much as you want in wages. You could earn $1 million a year in wages, and you won't give up $1 in Social Security benefits. So if you want to work and claim on Social Security, you can, but you have to be careful of these the Social Security earnings test if you're under your full retirement age. Okay, so I hope this clears up this myth. The next one I want to address is myth number 8. I stayed at home and I raised a family. I won't qualify to get Social Security benefits. Well, that's not true either. Now, if you're married, you qualify for what's called the Social Security spousal benefit. At your full retirement age, you get the option to take your own benefit or 50% of the primary wage earner's benefit, whichever is higher. That's a mouthful. So let me explain what that means. Let's say that he's making $3,000 a month in benefits, and you're making $1,000 a month in benefits. Well, you have the option. You could take either your own $1,000 a month in benefits, or you could take 50% of his benefit. Well, 50% of $3,000 is $1,500. So it's pretty clear that what you'd want to do is you'd want to take the 50% instead. The second part of this is that if you never worked and you're married, you could still take the spousal benefit. So even if you have no benefits coming to you because you didn't work outside of the house at a regular job, that's no problem. You could still get $1,500 a month in our example. So I hope this clears this up. The spousal benefit is a very important benefit for moms and for a lot of people. So know about the spousal benefit. I hope that clears that problem up for you. Myth number 9. If I die before my spouse, they'll get half my benefit. This is completely wrong. The survivor's benefit does not work this way. The way it works is that if you die before your spouse, they're not going to get half your benefit. What's going to happen is that the lower paying benefit is going to be taken away, and the highest paying benefit is going to survive. So let me explain this in greater detail. Let's say that his earnings in Social Security is $36,000 a year. Let's say that hers is $18,000 a year. So what happens here, if either one of them pass in that relationship, the $18,000 is going to be taken away and the $36,000 is going to survive. So you see what's happening here? This is really unfair, and it really kind of irritates me because if you think about it, you paid into Social Security. So if either one of you die, you should be you should be entitled to both benefits. But Social Security in their infinite wisdom has this rule. That's how it works. But it's important for you to know this, because when you plan your retirement and your income, you want to make sure that you have a plan that takes into account this possibility and have that income be there in case one person passes on before the other. The second part of this problem that no one ever talks about is that if one person passes away, the surviving spouse no longer files a joint tax return. So now the individual has to file singularly as an individual, which means higher taxes and a bigger tax bite. And again, this is why you have to have a plan that's unified, that takes into account and coordinates holistically everything that you have to work with, to include your Social Security. So let me just take a break. For those that are just coming in new, I'm John Davis. I'm a CFF, financial planner. I do retirement and estate planning. My clients are people that are nearing retirement and those who are already retired. Now, let's look at myth number 10. I can't afford to retire. I have to wait until I'm 66 or 67 to have enough Social Security and other income. Besides, everyone knows that you can't increase your Social Security benefits after you start receiving them, right? Well, no, that's not exactly right. Some of you might be sick of COVID and the grind at work. Well, here's the good news. You can actually retire at 62. You can actually take Social Security early and still increase your benefit. You can do that by considering a new Social Security claiming strategy. I call it start, stop, and start. Start, stop, and start. I'm letting that sink in for a second. So how it works is that you turn on your income at age 62, and you take your Social Security income and you take that until age 66 or 67, whichever your full retirement age is. Now, once you reach 66 or 67, you can call the Social Security office and you can have them put a pause on your benefits. Now, we're not filing the Form 521. We're not withdrawing our benefits. Again, we're just putting a pause. Besides that, if you filed at 62 and you're now 66 or 67, you're past that 1 year period where you can withdraw your benefits anyhow. So again, we're just putting a pause on the benefits. So next, what you do is you turn on your private pension. So you might be saying to yourself, okay, where's this private pension come from? Well, by taking your 401ks and your IRAs and investing them with me, I can set up a private pension plan for you, one that'll pay you a lifetime income for both you and your spouse. Okay, now what you're going to do is you're going to go back and turn on your private pension at your full retirement age, 66 at 67. And when you do that, you're going to actually be giving yourself a raise compared to what you were living on with Social Security alone at age 62. Now, because your Social Security has been paused, it's resting and it's still growing. It's growing at 0.2% per month. So the cool thing here is that at age 70, you're going to start your benefits again. You're going to turn your Social Security back on. You're going to take them off a pause, turn them back on, and you're going to give yourself another pay raise. Because between your age 70 Social Security benefit, which has grown, and your private pension, your income is easily double what you were taking out at age 62. And again, this is why you have to have a unified, holistic retirement plan that coordinates all of your assets. So I hope all of these myths go away. I hope that you plan your retirement and you enjoy your retirement. I mean, you really deserve to have that.